Hi, I'm Jim Short with the Spivey Insurance Group here in Indian Trail, and want to talk today about a topic that we get a lot of phone calls and a lot of questions about. Would be the workers' comp policy and why is it needed. And in North Carolina, you are required by law to carry workers' compensation if you're an employer and employ other people if you have 3 or more employees. In South Carolina, it's 4 or more employees. And this includes the officers of the corporation, or the owners, sole proprietors, or partners, or members if you're an LLC. So it's for the number of employees that you have. It's based on payroll. The reason you are required to buy it is it's good for the community as a whole, that if someone gets hurt, seriously injured, working at your job site or in your shop, that they have some benefits under the workers' comp program for lost wages, and they also have coverage for their medical injuries. The medical part of workers' comp is part 1 of the policy. It's covered up to, it's unlimited, it's whatever the medical costs are. There is not a limit on that. The second part of the workers' comp policy is known as employer's liability, and there are some limits for that, typically $100,000 or $500,000 for each accident or illness. Those are only brought about, those are lawsuits brought by third parties against the employer for gross negligence in administration of safety in the workplace. So really that's why it's needed. A lot of owners opt out on workers' comp, and I think they really should rethink that and probably choose to include themselves, even though they may have their own disability policies and their own health insurance. A lot of times health insurance policies will exclude work-related injuries. Therefore, if an owner is on the job, he's flying to another town to do business or driving, he's on the job. And you know, he could be in an auto accident or airplane accident and be critically injured. So I think a lot of owners should rethink opting out on the workers' comp coverage. It's based on payroll. It's always an estimated annual premium. It's always subject to audit at the end of the policy year to see what the actual payroll turned out to be. And then you settle up with the company. Either they owe you some return premium that's unearned, or you may owe additional premium to the company. And in a nutshell, that's why you need it, and kind of quick overview of what the policy covers and what it's all about.